investors panic and sell off their stocks at the worst possible time, locking in losses during a market crash. Instead of selling, Buffett suggests asking, "Would I still want to own this company for the next 10 years?" By focusing on the fundamentals and ignoring short-term market noise, you can avoid costly mistakes. So, if you're ready to learn what to do during a stock market crash and what is the worst mistake to avoid, stick around because in this video we are going to unpack the wisdom of Warren Buffett and equip you with the knowledge to navigate the stock market without panic. Understanding market psychology. When it comes to stock market crashes, understanding market psychology is crucial. Fear and panic can grip investors, leading to hasty decisions that often result in significant losses. During downturns, many individuals succumb to the emotional turmoil, selling off their investments at the worst possible time. This reaction is driven by a primal instinct to avoid loss, but it can lead to missed opportunities for recovery and growth. Take, for example, the story of an investor who sold all their stocks during the 2008 financial crisis. In a moment of panic, they watched the market plummet and decided to cut their losses, only to see the market rebound significantly in the following years. This is a common scenario where fear overrides rational thinking, causing investors to make impulsive choices that they later regret. In stark contrast, Warren Buffett exemplifies a calm and rational approach during these turbulent times. Instead of succumbing to fear, he encourages investors to remain level-headed and focus on the fundamentals of their investments. Buffett often emphasizes the importance of having a long-term perspective, reminding us that market downturns can present unique buying opportunities for those willing to stay the course. By understanding the psychological factors, investors can better navigate the emotional roller coaster or market crashes. Learning from both the mistakes of others and the wisdom of seasoned investors like Buffett can empower you to make more informed decisions even in the face of uncertainty. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. The importance of a long-term perspective. Maintaining a long-term investment strategy is crucial for navigating the ups and downs of the stock market, and this is a principle that Warren Buffett champions. Buffett's philosophy emphasizes the intrinsic value over short-term fluctuations, encouraging investors to look beyond the daily noise of the market. He believes that understanding a company's true worth is far more important than reacting to temporary price changes. For instance, consider companies like Apple and Amazon. Both experienced significant declines during various market downturns, yet they rebounded stronger than ever. Investors who held on to their shares during these tough times were ultimately rewarded as these companies grew and adapted to changing market conditions. This illustrates the power of a long-term perspective. While short-term losses can be disheartening, they often pave the way for future gains. Buffett often reminds us that investing is not a sprint, but a marathon. By focusing on the long-term potential of your investments, you can weather the storms of market volatility. Instead of fixating on immediate losses, it's essential to think about the future and the growth opportunities that lie ahead. As you consider your investment strategy, remember that patience and perseverance are key. By adopting a long-term mindset, you can make more informed decisions and position yourself for success, even when the market seems uncertain. Embrace the journey of investing and let the power of compounding work in your favor over time, avoiding the worst mistake. One of the most common mistakes investors make during stock market crashes is panic selling. When the market takes a downturn, fear can quickly take over, leading individuals to sell their investments in a desperate attempt to avoid further losses. However, this reaction can have dire long-term consequences. Selling in a panic often locks in losses and prevents investors from benefiting from eventual market recoveries. Consider the story of an investor who sold their shares in a well-established company during the 2020 market crash. Overwhelmed by fear, they decided to cut their losses, only to watch the stock soar to new heights just months later. This is a scenario many investors face, and it serves as a powerful reminder of the dangers of emotional decision-making during turbulent times. Warren Buffett consistently advises investors to stay the course, emphasizing the importance of maintaining a rational mindset. He believes that the best investment decisions are made when emotions are set aside. Instead of reacting impulsively, Buffett encourages investors to focus on the fundamentals of the investments and trust in the long-term potential. By avoiding the trap of panic selling, you can position yourself for future gains. Remember, market downturns are often temporary, and history shows that markets tend to recover over time. Embrace Buffett's wisdom and commit to a disciplined investment strategy, allowing you to navigate the challenges of the market with confidence and clarity. Opportunities in adversity. Market crashes can often feel daunting, but they also present unique investment opportunities that savvy investors can capitalize on. Warren Buffett has famously adopted a strategy of buying undervalued stocks during downturns, viewing these moments as prime chances to acquire quality assets at discounted prices. Instead of fearing the market's volatility, Buffett sees it as an opportunity to strengthen his portfolio. For example, during the 2008 financial crisis, Buffett invested heavily in companies like Goldman Sachs and Bank of America when their stock prices were significantly depressed. These investments not only paid off in the long run, but also showcased Buffett's belief in the intrinsic value of strong companies, even in challenging times. His approach served as a reminder that downturns can be the perfect time to buy, especially when others are panicking. As an investor, it's essential to shift your perspective and view market crashes as opportunities rather than setbacks. When prices drop, it can be a chance to acquire shares of companies you believe in at a fraction of their true worth. This mindset can lead to substantial long-term gains as the market eventually recovers. Building a resilient portfolio. Creating a portfolio that can withstand market volatility is essential for any investor looking to achieve long-term success. One of the key strategies to accomplish this is through diversification and proper asset allocation. By spreading your investments across various asset classes such as stocks, bonds, and real estate, you can reduce risk and minimize the impact of market fluctuations on your overall portfolio. This approach helps ensure that if one sector underperforms, others may compensate, providing a buffer against volatility. Warren Buffett emphasizes the importance of investing in strong, stable companies with solid fundamentals. He advocates for focusing on businesses that have a competitive advantage, consistent earnings, and a strong management team. By selecting quality companies, you can build a resilient portfolio that is more likely to weather economic downturns and emerge stronger when the market recovers. Additionally, it's crucial to regularly review and adjust your investment strategies. Market conditions change, and so do your financial goals and risk tolerance. By staying proactive and reassessing your portfolio, you can make informed decisions about reallocating assets or adjusting your investment approach to align with current market trends. If you want to know more about the path to prosperity, check out the video here and see you there.